and being able to help with the learning process, it's extremely important. Okay, so let me review here. So the question came up about rolling strikes with a strangle, and you know, and for those that don't have the permissions in their accounts to put outright strangles out there, either from, you know, just a risk standpoint or a capitalization standpoint, whatever it is, the same type of thought is going to come from having a short iron condor. So I mean, they're kind of fungible in that way. That's kind of, you know, I don't want to say it is a retail trader's strangle, where professional traders are very well capitalized people, or people that just have the risk tolerance and a broker that'll let them do it. A strangle, you're going to get more bang for your buck, more reward, more risk. Iron condor, same concept, same sort of thing has to happen, but it happens, happens on a different type of scale. All right, so the question revolves around when I'm getting ready to roll a strangle from 1 month to the next. He says, I never know you want to move the breached, never want to move the breached strike, i.e. if I have a short 8100 strangle and the underlying is at 95, meaning it's closer to the call side than the put side, is it proper to adjust your call up to recenter the trade on the roll out? Does that make sense the way I've asked it? I think I know where you're going with that. And then I think you asked, as long as you take in, sorry about that, as long as you take in a credit, which on a short strangle, you can always take in a credit, to move the break evens out, you are my hero for a book. Help me here. So I understand where you're coming from, and that essentially you have a bias that you have a range-bound stock in one way or another. That maybe that it's just not moving far outside of what would be considered a normal, you know, the normal move. That and you're willing to move that up and down, and as long as you continue to take in a credit, well, then you're good. And I would say that there's probably two things. I guess the most generic thing is that if you truly think it's range bound, that you would probably want, and you have no bias as to, well, if it does move, it's going to move up, or if it does move, it's going to move down, that you would want that strangle or the iron condor centered around those short strikes. Now, if there's a technical reason that you're looking at this, you know, you may change that. Let's just say, well, you're not in this room, but let's just say that you have a strangle and you have extremely strong support below, meaning the put side doesn't look. If you had to bet, and that's what you're doing, if you had to bet that if one side was going to get burned or the other, it would be on the call side, because you're seeing such a strong technical picture open itself up to to support on the downside. So let's just say that, you know, you have huge volume down below, you have the 200-day moving average down below, you've seen it trade down there 6 times and it always came roaring back. Well, I could see then maybe giving yourself a little more room to the upside than the downside. I could see that, you know, and I can't say that there's a hard and fast rule on when that is. You'd have to look at the actual chart that you are concerned with and make that decision. That being outside of that, I would say that if you strictly think that it's range bound, you probably want to keep yourself in the middle, because that's where you're coming from. You're saying, hey, this thing is stuck. So if it's going to be stuck, you want to be stuck in the middle. That would be the use of deltas of 16 for 70%. All right, now see, now you're getting into percent. Is that pop? Is that possibility of profitability? Okay. So now the big thing, and one thing that certainly Scott and I come from the same school of thought, that the probability of profitability is a dangerous concept. So one standard deviation range is, that means that you're talking about, let's just say generically, you're talking generically about a 32% move either way, right? Or so your deltas are probably too small if you're going out for 16 delta. Now, of course, the further out you go, the best chance of making money that you have, but the better chance that when you're wrong for big. So we both preach the concept of expected value. So expected value is the odds of something happening multiplied by the cost effect of something happening. So if, for example, let's just say that I have a trade, and let's just say that I have a strangle, and I'm gonna, and we'll just do this 10 times, and I make a nickel 9 times in a row, right? 9 times in a row, I make a nickel. So those 9 times give me 45 cents. If on the 10th time, I lose $1, well, then my expected value for doing that 10 times is losing 65 cents. So that is, and that, quite frankly, I get the same emails that you guys get from, if you want to call them our competition or other traders or whatever, is that, hey, I have a 90% win ratio. Okay, that sounds very impressive. Tell me about the 10% that you're wrong. Because that's what blows people out. It's not when you're right. And I call it picking up nickels in front of a steamroller. It works really, really well until it doesn't. And I say the same thing about selling premium. It works really, really well until it doesn't, because most people either A, don't care about the risk that they're taking, or B, aren't even aware of it. And that happens often when you get moves that are outside of what one would consider reasonable. Let's go back to Facebook. I use that because that was kind of the highlight earnings play this year. If I had to think of one that everybody could relate to, not this earnings, but 2 earnings ago, they were down 23% at one time. The projected move was 6%. And I don't know for sure. It's probably, if it's anywhere Facebook, it's usually between, let's just say generically, 6 and 10%. So it was more than double the move that the outside of the implied volatility, and like I said, I don't really recall where it was. We could go back and find out, but it's an illustration that there is no standard deviation that you were putting together that was going to make you safe on something like that. So that's why it's always about risk to reward. It's always about expected value. It's not only, and I do this fastidiously with my spreadsheets. If anybody is in the short-term options room and looks at my tracker, I have every analytic in the world, because, but really, a lot of it is, just numbers, and I get into spreadsheets and things like that. But a lot of it comes down to how often am I right, and what happens when I'm wrong. So, for example, this year, I think I was looking today. I have my room up. So on day trades, which is the most, we've done 337 day trades since March 1st. So we're active. My win to loss ratio, I'm right 63.5% of the time. I'm wrong 36.5% of the time. That sounds okay. Doesn't sound like 90%. Sounds okay. But my win to loss ratio is when I'm right a little bit over 12% profit. And remember, these are trades that we're in for like anywhere from 2 to 10 minutes. Some people hold them on for longer, but that's not the design of what I'm putting out there. So when I'm right, I have a 12% winner, and when I'm wrong negative 7.3%. So when you do that calculation, that annualizes out to a little bit less than a 95% return. So that's the kind of thing that you look at. Because if I was right 63% of the time, but I made 12% and I lost 25%, well, that's a completely different story. So, be careful with that. And it's a very it's an easy play to make to somebody who wants to do this. I'm right 90% of the time. How in the world can we lose money doing that? It's because you blow out on the 10th time. And I'm not saying this is what you're doing, Brian. I'm talking generically, but to cite probability of profitability is, I will say that it's either aggressive and or dangerous. And if you're right 90% of the time, and your win-loss ratio of how much you win and lose is roughly the same, you're going to kill it. Because whatever you're doing, you're right 95% of the time. Who cares is if that 10% of the time you lose as much as you make. Usually that's not the case. Usually. That's well, the thing is that that's hard to say, because we don't in the room we don't do strangles, because we could do long strangles, we can do long straddles, but we can't do short ones, because we know that I think that it would be unfair to many, I'm just going to go out on a limb and say 90% of the people in the room can't do that, either because of the type of account they are in, or their account size, or just risk tolerances, that they can't do that. And so for us to put out, hey, I'm just going to sell a strangle, and, just like in the old days, on the floor, and manage it. Because the thing is on the floor, if you had, if you were somebody who traded premium from the short side, if something went wrong, you usually had a chance to at least have a chance to get it back, or manage it somehow. In a retail setting, if you get a move like that, and I'm going to go back to Facebook, there's no market for you to get out. You just sit there and take it, and then hope for it to come back. So to have a hard and fast rule in a retail setting, I would say that we don't have one. I would say that in the case of an iron condor, usually when we're doing iron condors, they specifically in this room, they're done in and around earnings. And typically in and around earnings, given where the levels of implied volatility are, we're usually, I tend to be actually a little bit more aggressive than Scott generally. But I would say the general rule is laying 1.5 to 1. That would, so you risk $1.50 to make $1. Somewhere in that range. Now, strangle, you don't know where you're getting out. You have undefined risk. You could say, well, from a probability standpoint, this isn't going to happen. Well, probably you can't waive your probability at them when the thing moves 5 standard deviations on you. That's an extreme case. If you're close to the action and you're close to the order flow, you can definitely do it. Thing is that most, if not all, retail traders don't have that accessibility. On the floor, we did. I could be short straddles and short strangles given, certain market things where I was at least somewhat confident that we'd be able to get that premium back or trade around that short position. Okay, I don't want to cut it. Well, I think that answers your question. I don't want to cut it too short, but we only have 4 minutes left. I want to I want to go back and toggle between both rooms and tell everybody to have a great weekend. I will. That does. It does. The IVR is but that's only in a a controlled setting. If your IVR is based on a 52 week, that's just where it's been for the last year. There's if you did that 2 years ago compared to now, where would you be on IVR rank? Vol's a heck of a lot higher. We were talking about VIX levels that were, it got in a 9 handle. Now it's in the 30 handle. So that's a great question, and I'm not saying that what you're doing is wrong. I'm just giving, from a retail trader standpoint, I'm giving my perspective, because the last thing that you want to do is take yourself out of the game, and you can do that by selling naked premium. I would much rather bunt and bunt and bunt and bunt, maybe get a double somewhere in there and be around for the next day, as opposed to hoping and hoping and saying, well, this is statistically impossible that I could ever blow myself out, until it happens. HV doesn't matter. How often do we look at HV in here? Anybody? Just tells you what it did in the past. I'm not saying that it can't be a gauge of where it can be, but if stuff changes, stuff changes. Well, this is an 8 vol stock. Well, tell me now that it's now trading 25. What are you going to do about it? No, that's a good approach. All right, I have to hop. I'm not leaving or anything like that, but I did record this. I'll put that up in the room. It's going to take a little while to render, and then we'll talk about anything anybody wants to talk about. All right.